for you to take your FD money and to invest into somewhere which is not too high risk to generate higher return is to invest into fixed income funds. But in most of layman term, we call it bond fund. So if I were to do a comparison between Maybank FD and fixed income fund, we can see that the initial investment is actually quite low. And of course, for fixed deposit, it is capital guaranteed if there's a PIDM involved. But for bond fund, there is no guarantee of the capital. And as far as diversification is concerned, what you can do is that you can put your FD into a different bank. And for fixed income fund or bond fund, manager will construct a fund whereby you invest into maybe 10, 15, 20 of bond papers, normally corporate bond papers. And the liquidity that you have under FD, like what I mentioned before, you may need to forfeit your interest, whereby bond fund, there's no such thing of maturity period or forfeiting your interest. So FD has got fixed maturity date and fixed income fund has got no maturity date. And FD, as an investor, you yourself have to go and look for which bank offer higher interest, and then you may move the money from one bank to another bank. Investor, basically, you need to manage it yourself. For bond fund, it is managed by a professional or licensed fund manager, and they are the one who manage it for you. And the benefit of a bond fund is low risk. Of course, when we say low risk compared to equity fund or compared to one single bond paper. And then it also offers tax exempted advantage and also offer a better return. Normally, when you invest in bond fund, generally it can give you about maybe 4 to 5% kind of return, and it has got no lock-in period. You can invest and you can withdraw the money almost anytime that you want. Now, I want to highlight here very specifically that this bond fund that I'm talking about here is not direct bond. Direct bond meaning that you invest directly into one piece of a bond paper. So let me share with you the comparison. For direct bond, chances are you will invest into one bond paper, whereby a bond fund, you invest into a fund and the fund manager will diversify into maybe 20, 30 or even 50 different bond papers. So that is a diversification there. So if one bond paper default or for whatever reason drop in price, that is only maybe 2% of the total portfolio or maybe 3% of the total portfolio. So with the bond fund return, you can easily cover it and grow again. But if you were to invest, say for example here, initial investment of 250,000 into one bond paper, even though this is a bond paper issued by a listed company, if something go wrong to that bond paper and the company, they are not able to pay the coupon or they can't even pay the capital back to you, then your 250,000 is at risk. So for bond fund, you do not need to put so much money. You can put 10,000, 20,000, so it's diversified. Of course, for direct bond, you may get higher return, maybe 1% extra because there's no management fee. For bond fund, you've got a management fee because there's a manager helping you to select a bond, helping you to trade the bond and manage a bond portfolio. So the return maybe 1% or lower than direct bond paper. But we must be aware that to put 250,000 into one piece of direct bond, that is pretty risky. If you were to diversify into like 20, 30 bond paper, then the risk is very much reduced. So be very careful. When I talk about bond fund, I really mean a fund and a portfolio of bond paper and not a single bond paper. You see, bond fund, based on the platform that we use, has got many options as well. Almost every fund house offer bond fund, some longer duration, which means a bond that got a longer duration, and some bond paper that has got shorter duration. But you can see the returns, just now I say about 4 to 5%, but their actual performance can be higher than that. So what do I suggest? Because some of you may think that if you were to go to a money market fund only, or then the return may be too low. It's not much higher than FD. But if you put in bond fund, then you're concerned about the risk that the bond may default and things like that. So I always advise investors is that we can always, you don't have to like put like black or white kind of solution. We can do a combination of a gray solution. What do I mean by that? You can see if you save 100,000 in fixed deposit, and you really cannot stand the fact that the interest rate is so low, and you want to increase the return, what you can do here is that you can, if you are a very low risk investor, you can take the money out and put 100% into a money market fund. And that may give you a return based on past performance about 2.89%. And if you say you're willing to take slightly more risk, then you put 80% of 100,000 into money market fund, 20% into a bond fund, then your return increased by almost like 1%. And if you say, I don't want to take slightly higher risk, then I put 60% in money market fund and 40% in fixed income fund. Then your return also increased by another 1%. So depending on your own cash flow, depending on your risk appetite, you can definitely find a way to increase your return by looking into some low risk investment vehicle like money market fund and bond fund. Now, of course, if you go to buy from bank or buy from certain fund house or money market fund, and especially fixed income bond fund, they may charge you 1% or 2%. So that is not so good for investor. So there are certain companies like us who are like corporate unit trust advisor, like Ringgit. We offer this kind of money market fund and fixed income fund at zero sale charge. So for that matter, that would definitely be a better deal for any investor who want to look for the higher return for your money to work harder.
If money is important to you, please remember to subscribe to my channel.